Many believe the hardest part is saving the first $100,000. And it's true. But here's the paradox. Once someone reaches this milestone, they think the rest will happen automatically, as if $1 million will arrive by inertia. That's a mistake. In reality, $100,000 isn't the finish line. It's the beginning of a new game. And the rules of this game are very different. Before $100,000, you were the engine of your wealth. You worked, saved, hustled, cut back. Everything depended on your effort. But once the number becomes 6 digits, the situation changes. Now money itself becomes your main tool. It can work and grow without your constant involvement, but only if you know how to direct it. The secret to turning $100,000 into $1 million is not magic or lucky breaks. It lies in discipline, strategy, and the ability to leverage systems. Surprisingly, most people lose focus once they hit $100,000. They start spending, relaxing, or even gambling on risky investments. The result? A painful step backwards. Think of $100,000 as a team of employees. Each dollar is a worker. You have 100,000 workers. Your job isn't to fire them or let them sit idle, but to ensure each one works 24/7. You can assign them to different departments: investments, passive income, business. But if your workers are idle, your company won't grow. The key difference between $100,000 and $1 million is that at this level, what matters is not your labor but the growth rate of capital. With $10,000, even a 10% return is modest. But on $100,000, that same 10% is $10,000. And on $1 million, it's $100,000. The secret isn't working harder. It's creating conditions where your money works smarter. Many make a fatal mistake. They try to speed up the journey from $100,000 to $1 million with quick wins. Crypto, hype stocks, risky bets. Sometimes it works, but more often, it wipes out their capital. You don't get a second chance. That first $100,000 is the launch pad. Lose it, and you're back at zero, only this time the climb will be harder. The right path lies elsewhere. You need to build a system that works for years. That means a combination of reliable long-term investments, income growth, and discipline in capital management. You don't need to be a financial genius. But if you create a system where money generates income and income is reinvested, the effect is inevitable. Picture a snowball. At $100,000, the snowball is already big enough to roll on its own. But your job is to keep it from breaking apart and to make the slope steeper. In other words, to accelerate growth. Every reinvested dollar increases momentum. Every mistake or indulgence slows it down. That's why your first task after $100,000 is to protect the capital. You must treat this money as a resource working for you, not as a pot to spend on pleasures. Car, a vacation, a new gadget. Tempting, yes. But every dollar spent is a worker fired. And the more workers you lose, the harder it is to reach $1 million. Before pressing the accelerator, let's fix the formula for moving from $100,000 to $1 million. 3 levers: contribution rate, how much money you add monthly/annually, average return, annual percent before fees and taxes, and time. You don't control the market, but you do control the first two. The paradox is simple. At $100,000, even average returns do heavy lifting, and every extra contribution accelerates the trajectory non-linearly. Roughly speaking, the rule of 72 shows that at 10% returns, capital doubles in 7 to 8 years. At 15%, faster. At 6 to 7%, slower. But add consistent contributions, and time to $1 million shrinks dramatically. The plan is not to guess the perfect year, but to organize the flow and protect the speed. First, the liquidity base. $1 million isn't built on credit fumes, but on a stable foundation. An emergency fund of 6 to 12 months' expenses, kept in a reliable, interest-bearing account, is your insurance against selling at the bottom because you need cash. Add risk coverage, health/life/asset insurance at a rational minimum, so a single event doesn't wipe out the investment engine. The reserve equals psychological shock absorber. It gives you patience to play the long game and keeps you from touching investments during downturns. Without this cushion, Every dip feels like survival, and you'll break discipline with emotional trades. Next, portfolio architecture. A working model is the core, satellite approach. Core, 70 to 85%, equals low-cost broad index funds, global/US/developed/emerging, that give you the market machine without trying to predict tomorrow's headlines. Satellites, 15 to 30%, equals carefully dosed spice. Factor tilts, value/quality/small cap. REITs, global dividend ETFs, maybe thematic slices if you have a thesis, but not obsession. Golden rule: one spice equals max 5 to 10% of portfolio, and satellites in total never steal the show. The lower the fees and turnover, the higher your odds of arriving wealthy and intact. Third layer: flows and automation. Set up DCA, scheduled buys, monthly/bi-monthly, and automatic dividend reinvestment. Add event top-ups, bonuses/freelance/extra paychecks, automatically routed to Invest Plus. Use a sliding tithe. A fixed percentage of every incoming flow goes to capital before it hits spendable. This removes micro-decisions from your daily life and shields you from emotional impulses. Discipline is not equal to asceticism. It means rules written before the storm. Define a rebalancing policy, annually/semi-annually or by thresholds, classic 5/25. Asset class deviates 5 pp or 25% from target equals rebalance. Rebalance tax efficiently, inside retirement/tax-advantaged accounts, or through new contributions/dividends to minimize selling. Ban yourself from treating the market with micro-tweaks every 2 weeks. That's usually trading math for dopamine. Risk guardrails keep speed intact. Blacklist, leverage to accelerate, oversized bets, greater than 15 to 20% in one asset, running high-interest debt while investing, chasing losses with derivatives. Whitelist, position limits, no single risk sinks the plan. A pain threshold, maximum portfolio drawdown after which you only rebalance, not add risk, and the unchanged contribution rule, you keep adding on schedule even during drawdowns. That's where future profits are born. Speed to $1 million depends not only on markets but also on income. After $100,000, your focus must be turn human capital into higher cash flow. Think offense 12 plan. Pick one premium skill, analytics, product, sales, engineering, media. Set an annual income KPI, plus 20 to 40%. Tie learning to your calendar, 2 hours per week non-negotiable. And monetize via raise, freelance, or launching a side product. An extra $1,000 per month, funneled into the portfolio core, makes a dramatic trajectory difference in 5 to 7 years. More than any hot stock pick could. Your biggest enemy after $100,000 is lifestyle creep. It eats acceleration quietly. Set minimum/ceiling rules. Baseline expenses rise only with inflation plus a small premium, but all unexpected income increases go to capital by default, e.g., 70-30th split. 70% invest, 30% lifestyle upgrade. Add a 48-hour rule for purchases above a threshold and a quarterly Black Friday day to buy postponed wants, and only then. The system ensures habits win over fatigue. Efficiency equals taxes plus fees plus turnover. The difference between 0.1% and 1% in costs looks tiny but compounds into hundreds of thousands lost. So low-cost ETFs/indexes for the core. Satellites only with clear hypotheses and timeframes. Not just to do something, avoid needless trading. Dividends/coupons. Shelter them inside tax-advantaged accounts when possible to defer taxation. Any free yield you give to fees equals subtraction from your future million. A second engine that can shave off years is a managed entrepreneurial option. Microbusiness, product, service equity, or acquiring a small cash-flowing asset, e.g., SaaS or local service. Safety rules. No more than 10 to 20% of portfolio in one project. Cash flow story, real inflows, not promises. Exit scenarios pre-written. Diversify across ideas. Entrepreneurship isn't a replacement for the market. It's an accelerator when applied in the right dose. To avoid drowning in noise, write an investment policy statement, IPS. 1 page. Goal, $1 million in time frame, annual contribution plan, target allocation, course/satellite, rebalancing rules, risk limits, channels for new money, and a forbidden actions list, leverage, margin longs, hot tips. Print it, sign it, keep it visible. Add friction against impulses. 2-day delay before selling, a sandbox account, 1 to 3% of capital, for experiments, time limits on news feeds. We keep the system cool enough to run, while you conserve energy. Finally, the milestone ladder. Break the path into $100,000, $250,000, $500,000, $750,000, $1 million. Each milestone equals mini reboot. A. Review IPS. B. Adjust income strategy. C. Analyze effective expense/tax rate. D. Mental marker. I'm a capital manager, not an adrenaline junkie. At $250,000, returns in dollars feel real. At $500,000, the portfolio often grows faster than your contributions. At $750,000, the main risk is overconfidence and boredom. Your job: don't break the working machine and don't knock yourself out of the saddle. In Part 3, we'll dive into bear market behavior, crisis portfolios, barbell strategies for resilience, and how to stay the course when the world screams, buy, sell now. Once your capital passes $100,000, a new risk appears: not losing everything in one fatal event. Up to this point, the main challenge was saving. Afterward, the main task is to preserve speed and not break the system. This is where the concept of anti-fragility comes in, the ability not only to survive shocks but to benefit from them. It means your portfolio must be built so downturns don't destroy it, but instead create opportunities for future growth. The first element of anti-fragility is asset diversification. Never bet everything on a single class. Only stocks, only crypto, or only real estate. The key is that different parts of your portfolio should react differently to the world. When stocks fall, bonds or gold often stabilize. When real estate stalls, stocks may rise. Diversification reduces volatility and makes drawdowns survivable. And remember, diversification isn't own 50 stocks, it's own asset classes with different sources of return. The second element is crisis liquidity. You must keep a slice of capital you can quickly access in a black swan event. This isn't money for returns, it's money for survival. For example, 5 to 10% of the portfolio in ultra-safe instruments, short-term bonds, deposits, cash equivalents. This is your reserve fuel when markets crash and you either need to hold on or even buy assets at a discount. The third element is psychological preparation. When you watch your portfolio fall 20 to 30%, your brain screams, "Get out!" And this is the moment most people make the fatal error: selling. To avoid it, visualize the worst-case scenario in advance. What will I do if my portfolio drops by 1/3 tomorrow? The answer must not be panic, but rebalance and keep contributing. Writing rules before the storm saves you during the storm. There's a strategic model that helps balance in tough times: the barbell strategy. The idea: one part of the portfolio is ultra-conservative and provides stability, bonds, cash, gold, while the other part is aggressive and drives growth, stocks, business, riskier projects. The middle ground is often the least rewarding: too risky for safety, too weak for growth. The barbell gives you both a shield and a sword. The biggest mistake after $100,000 is thinking, "Now I'm smart, I know everything." That's the illusion of control. In reality, the world is more complex than any plan. Remember 2008, 2020, or any crash. Nobody expected it, yet markets always find a way to test investors. Your goal is not to predict, but to endure and exploit. Those who bought in crises instead of fleeing shaved years off their path to $1 million. Psychology plays a huge role. After $100,000, the numbers start to feel big. When your portfolio loses $20,000 in a week, it's not just digits. It's a car, a vacation, a year's salary. The key is to remember: it's not a loss if you don't sell. It's a temporary markdown of assets. This is the moment that separates the speculator from the capitalist. The speculator runs, the capitalist waits and buys. Another danger is boredom. With $200, $300K, it feels like the system is running itself. You start looking for fun in the market. New hypes, risky bets, maybe I'll get there faster. But this is when many people lose years of progress. You must learn to enjoy stability, not thrills. Boredom isn't the enemy. It's proof your system is working. To lock in progress, set storm behavior rules. For example, I never stop contributions. I rebalance by plan, not emotion. I only experiment with 3% of capital. I never borrow to invest. These simple rules form the scaffolding that keeps the system intact even when your brain can't make rational choices. Historical perspective helps immensely. Look at S&P 500 charts for 50 to 100 years. Every crisis felt like the end of the world, but years later it was just a small dip on an upward line. Those who held and kept buying always won. Those who panicked lost. Train yourself to have a long memory and faith in math, not emotions. Ultimately, an anti-fragile portfolio and the right mindset let you turn $100,000 into $1 million not only faster but with less stress. You're not trying to outsmart the market. You're building a system that works in all weather. Every crisis is not a disaster, but a sale. In Part 4, we'll explore how to accelerate the jump from $500,000 to $1 million, how to shift focus from just saving to building a wealth machine that works without you. When your capital reaches $500,000, you enter a completely new stage of the game. Halfway to the million is behind you, but now a new psychological trap appears. It feels like the goal is already near, and you want to speed it up. Many people start chasing risky bets, investing in a startup, buying speculative crypto, or pouring a large chunk into a single stock. And often, at this stage, people lose tens or even hundreds of thousands. The truth is that after $500,000, you must be even more careful than before. Every percentage point of volatility now equals thousands of dollars. At this level, your capital begins to work faster than you do. For example, at an 8% annual return on $500,000, you earn $40,000. That's more than the average yearly salary in many countries. In other words, your money is now employed and producing an income comparable to a person. But the biggest mistake here is spending that income. Instead, it should be reinvested into the system to hit critical mass at $1 million. An essential principle after $500,000 is protection from overconfidence. You've already proven you can build wealth, and the thought arises, now I can take more risks. In reality, this is the moment when you can least afford it. Losing $50,000 isn't just money, it's years of effort and a slowdown of your trajectory. It's better to grow at boring 7 to 10% per year than chase 50% and risk losing everything. The final half of the journey to $1 million requires a shift from a saving strategy to a wealth machine strategy. Up to $500,000, you were mostly an investor consistently adding contributions. After $500,000, your goal is to turn capital into a system that creates new income streams by itself. This can be business ventures, dividend-paying stocks, rental real estate, or online projects generating cash flow. You are no longer just investing. You're building a financial engine. One way to accelerate the path is through diversified income sources. If you rely solely on the market, your speed is limited by its return. But if you simultaneously create additional streams, freelance, business, consulting, creative projects, they accelerate capitalization. The key is that these streams shouldn't consume all your time and energy. Otherwise, you risk burning out. The system should work so that multiple income flows merge into one stream, boosting your capital. The next element is systematizing investments. By this stage, your portfolio may already hold tens or hundreds of thousands spread across many assets. You need automation tools, trackers, rebalancing services, tax planners. This minimizes mistakes and saves time. Remember, the bigger your capital, the more expensive each mistake becomes. It's critical to learn the difference between growing capital and growing status. Once you see hundreds of thousands in your account, The temptation appears to show off. Buy a car, a house, a luxury watch. But these purchases delay your million. Ask yourself, what matters more, impressions today or true freedom tomorrow? Truly wealthy people become visible later. During the building phase, they often look modest. The path from $500,000 to $1 million can be split into 3 phases. First, from $500,000 to $700,000. Growth feels slow, but investment returns are already significant. Second, from $700,000 to $900,000. Acceleration kicks in, and each new month adds tens of thousands. Third, from $900,000 to $1 million. The goal feels almost achieved, but psychologically, this is the toughest stretch because you're tempted to harvest early. The key is to endure and not quit. The main secret of the final stretch is patience and discipline. The million isn't the result of a miraculous market day, but the outcome of years of systemic play. At this last stage, it's especially important to stick to rules. Regular contributions, automation, expense control, and avoiding excess risk. Here, winners aren't the smartest, they're the most consistent. Once you reach $1 million, you realize, money is no longer the goal, but the tool. The million becomes a wealth machine that generates income by itself. Your job now is to manage this machine. Keep it running, defend against inflation and taxes, and gradually redirect income toward new goals, like creating passive income for your lifestyle or building a legacy. So, the real secret to turning $100,000 into $1 million is simple. It isn't a single step or one brilliant decision. It's hundreds of small disciplined actions woven into a system. It's the ability not to quit during crises, not to give in to temptations, not to lose focus on the long road. A million isn't a product of talent but of character. Ultimately, your first million isn't just about money. It's about a new identity. You're no longer the person trying to save. You're someone who builds and manages capital. That shift in mindset matters more than the million itself. Because once you reach that point, if you could build $1 million, you can build $5 million, $10 million, and beyond.